Hello, welcome to another edition of Nucleus Investment Insights. It's a little bit of a mixed episode today, so I wanted to run through a little bit what was happening in terms of I wanted to sort of update for some of the data I've spoken about last week in terms of valuations, in particular, just sort of drilling in a little bit further. I think last week last week I focused a lot on the top 20%. And I wanted to sort of focus in on the top 2% instead, and just to show that it's I guess even more extreme than what I was showing last week is that the differences that we're talking about in terms of valuations really does sort of just stretch those top companies. So I thought I'd touch on that a little bit, and then I just want to touch on some of the latest housing data. And I think that the issues we've got around that housing data is it's interesting insofar as we're seeing house prices obviously rise, and if we're going to see further rate cuts, then it looks likely to see even more of that. And I guess I just really want to talk about these affordability statistics and where they're sitting with all the changes that's going on. We've seen a lot in terms of rent rises, but now we're seeing house price rises, and some of the relativities, is really switching around a fair bit in that area. So I will jump first to the valuation side, and so I just want to highlight. So the same charts we were talking about last week. Outside the tech bubble, global markets have never been more expensive than where they are today. But then when you jump into and I've just sort of got a chart up showing how I'm just going to split into four different buckets to sort of look at each different sort of segment of companies. The first is sort of the largest 2% of companies, and they make up about 37% of the market weight. So this is sort of, and I'm talking about the global 1500. So it's sort of like, close to 30 companies that sort of fall into that bucket. Then Then I've got the next, up to 20%. So the next sort of 18% by size, and they make up roughly the same amount. So another 36% of the market. And then you get that sort of middle 60% of the market by number, and so that's sort of the 900 odd stocks that sort of sit in the middle there by size. They make up 25%, and then the smallest 20 give you 2% on the other side. So yes, that's the different buckets we're using. And when you look at it this way, it's really clear that actually it's only those larger stocks that are really expensive relative to where they've been for the last 20 years. So they're sort of trading at 28 to 30 times earnings, whereas the rest of the market, that's these green lines, the couple of green lines and the black line that we can see on there. So that and what we can really see with those is they're basically in line with where they've been for the last 25 years. So no real differences in terms of that. A little bit more expensive, but for most of them, the smallest ones are actually a little bit cheaper, but really we're sort of sitting at sort of historical averages. And then you get I've got another chart there just down the bottom just showing the 24-month forward numbers, which is a very similar type of look upon that. So that's that part. When you look at this, and what's also interesting is that if you said, okay, well, what about the cheapest stocks within that? And I spoke about that. They're a little bit cheaper than ordinary, and so I've just picked it's relatively arbitrary, but I've said, well, if you're trading on less than 12 times the forward price to earnings ratio, that's cheap. And so at the moment, there's about a quarter of the market trading under that. So if you went back to 2016, when valuations were much, much lower, you had way fewer stocks at that point. And if you went back to sort of pre-crash in 2006 and 99, when you were running these quite large bubbles, again, a lot fewer stocks trading at those lower multiples. And so, so from that point of view, you're like, okay, we really do have a sort of phased market in terms of the different sectors. Then there's that same idea I spoke about the sector weights and what they mean. So how much of those 2% are high PE sectors versus low PE sectors? And when you look back to sort of the mid 2000s, there just weren't many tech stocks within that sector, and now we've got plenty of them. And sorry, in the high PE sectors, I've got tech, services, and consumer, which all tend to trade on higher multiples because of the nature of the businesses. So it's that idea that, well, if you've got lots of banks in the index, say in the around 2008, 2010, you would just expect the PEs to be lower at that point. And then finally, the other one I wanted to sort of touch on is if you just look at all the different sectors, and I've spoken a little bit about those, that tech sector and services and finance and everything like that, they're quite broad groupings for these. So, I guess, they're quite broad groupings, but they're sort of more similar to how you'd look at it from an investment perspective. Is what you see, and I've broken this net into the median price to earnings per sector. And so we're just ignoring size and saying where's the sort of middle stock. So if there's 300 stocks in the sector, what's the 150th stock? What's that trading at? If we just rank them all by price to earnings ratios, and on that basis, basically everything again just looks about normal, except that the tech sector is a little bit expensive, but it's been expensive for 5 years now, and it's not like dramatically so. And where we are today is lower than it's been for most of that 5 years. And so keep coming back to that same idea that, we've got this choice at the moment in terms of investment between saying, do we want to go for companies that are large and trading on higher multiples? So our sort of top 10 or 20 stocks in there, and then the NVIDIAs. Do we want to go for those companies that are generating this massive growth, are large stocks, and are priced that way? So they're priced for, they're priced at much higher multiples, but they're getting the growth. Or do we want to invest in a whole basket? Do we want to try and say, well, this market's too expensive? Well, what I'll do is I'll avoid it by buying all these small and mid cap sort of industrial stocks sort of sitting around. And the idea then is, okay, well, if that happens, are they actually they're on much more normal multiples, and you're buying that sort of what you'd seen in the past. But are you running the risk that there's actually earnings downgrades in that, and the Trump tariffs and shutdowns and all the other factors that are going into demand actually mean that that sector doesn't perform as well over that time frame? So so a sort of bit of a distinct choice within that. I think for what we're doing within these is that we're sort of taking the view that, look, there are cheaper stocks out there that we think are actually going to hold up, and especially if we go into sort of the types of economic slowdowns that we're expecting. And so we're trying to get our quite a reasonable exposure to those ones. But we're also recognizing that, look, there's a lot of growth within these, within a lot of this AI, and particularly the data center side that we've sort of focused on for the last few weeks. And so we do want exposure to that in terms of the right companies at the right prices. So we're less interested in sort of getting the stocks that are trading at hundreds of times ratios in terms of what they're in terms of what you can buy in, but we are certainly interested in buying the stocks that are if you can buy them on multiples of sort of 25 or 28 times. So yeah, it's a fair bit above what some of the other stocks might trade. But if they're going to grow 10% faster, then it doesn't take that many years before that's sort of justified in terms of paying that extra multiple. And so that's where we're sort of treating this that side of the market. In terms of so that's those. Then I want to jump back to the property side. Now we've got this property calculator we've got on the website, and a lot of this is looking at these ratios of different versions of how to look at property, and what we do is, there's this idea that, look, we've got this property price, and how do we actually benchmark that to what's reasonable and what's not reasonable? And for us, there's a bunch of different ways. There's investment return ways, like what are you going to get in terms of yields on property versus others. But property is a bit of a different asset in that people really need it to live in. And when you're going through these, when you've got shortages and that you can have other sectors where if cars get really, really expensive, people just say, well, I'm going to leave my current car for a longer time, or I'm going to do whatever it is, and I won't sort of go in and buy those. But housing is sort of, well, yeah, you actually need to have somewhere to live every day. There's cars, you've got you've got public transport, you've got bikes, and you've got you can rent cars, and you can get taxis and stuff like that. But for houses, you're sort of pretty stuck in terms of that ongoing expense. And so we've sort of stepped out and said, well, there's an investment side of it, which sort of makes we should look at as well. But actually, what's more important for coming up with long-term values is really looking at the alternatives. And what I mean by that is saying, well, really what we want to know is what's it going to cost for a mortgage versus what's it going to cost for rent, because that's a key metric everyone's looking at. If you're looking at, say, Sydney at the moment, and we've got it's going to cost twice as much to get a mortgage as what it is to rent. Well, that's less attractive than other times in its history where it's traded more like an equal amount. Actually, let me bring some of these charts up, so we can actually look at those. So I've got these. I've got the Sydney sort of mortgage payment to median wage for houses, and you can see over. I was talking about mortgage payment to rent was what we're looking at. So the mortgage payment to rent over that time frame has sort of ranged from around about 100%. So over a lot of these longer times, and the peaks before this recent one was sort of more like 180%. And so the idea was basically, look, if your mortgage payment was going to cost you less than rent, that's people would tend to be buying houses rather than renting. And when mortgage prices to rent sort of got into the significantly above, and at the moment we're sitting at double, and for a while that sort of sat there at 2.3 times, that you then got less demand. So despite the rises in price, because of the cuts in mortgage rates and because of the increases in rents we've seen, that mortgage to rent ratio has actually been coming down in recent months. And so, it's still at the sort of 93rd percentile of where it's been. And if you look at it over time, I guess the more normal level for Sydney, if you took that sort of longer term average, is probably closer to 150% or something like that. But so it's still expensive on an absolute basis, but it's certainly been coming down in recent times. And then similarly on this mortgage payment to median wage, so that was one measure. The other measure we had just above that is then saying, well, people need to be able to afford to pay their rent. And so if we look at this and say, what's the ratio of the median wage within New South Wales versus the houses within Sydney, a median full-time wage, how does that sort of stack up over time? And again, that sort of 50 to 60%, I think, has been sort of the historical part. We're at 90 at the moment, so still well above historical ranges, but coming down. And that's that, I guess, that push and pull we're seeing in terms of those, in terms of where they sit. The property price, and the final one we look at is just the property price to median wage, with the view that, look, you need to be able to save up enough to get a deposit, but we actually feel that's a less of a that measure has much less of a factor on property prices than the above two, insofar as, look, you need to get in once, and whether that means it's a bank of mum and dad, or if it's the other things, you're getting loans, or you're getting inheritances, or whatever it is. There's something that can get you into that property market, but once you're there, you still need to be able to afford to pay for these mortgages. And so that's sort of, I don't want to exclude that. I think it is worth knowing, but you sort of look at that over a longer period of time. It's sort of gone from 3 times property price, sort of 3 times median wage to 15 or 16 times where we are today. And it's hard to know where do you cap that? Like, has that got an upper limit or not? Is there, is it just that, you're going to end up houses passed down and other things? Whereas I feel as if there's on the mortgage payment to rent and mortgage payment to median wage, we can sort of benchmark that and say, well, yes, look, if mortgage payments are so much more expensive than rent, then people are just going to opt to rent versus the wages. So that's where the houses sit. In terms of units, they're much more reasonable. And again, I'll have a quick flick through a few different cities, but the Sydney mortgage payment to rent is basically at its 50th percentile at the moment. So it's 125%. So it's going to cost you 25% more if you have a mortgage versus renting. But that's it's long-term average. It's not significantly different. The wages at 44%, so that's at the 61st percentile, so pretty close to average as well. And that seems to be a lot more of a stable series within that. So, on those fronts, affordability for units looks, relatively reasonable. Well, I don't know what you call it reasonable, but certainly looks within historical norms. Within Melbourne, similar types of figures. The numbers sort of aren't as high. So the Melbourne sort of topped out at 200%, but it's actually come back pretty quickly. It's more like 160% now in terms of mortgage payment to rents. And again, that's sort of, okay, it's expensive, but now, whereas the Sydney ones were at the 97th percentile or something still, that's back to the 80th percentile. So, it's expensive, but, it has been there on several occasions in the past. And then mortgage payments to median wages are particularly high still. They're still at the 90th percentile, but coming down as we're seeing those rate cuts come through. Jump to the units, and very similar to what we saw. They actually look cheaper than average when you look at it on this basis. So, Melbourne mortgage payment to rent is sort of 103% on a unit, which is below the average it's been for the last sort of 50 odd years. I think I've got data for going back on this. So, so I guess it's that thought behind, look, if you're looking at house prices and particularly unit prices and going, there's no way these things can go higher. Well, a few more rate cuts and, that there certainly wouldn't be outside the normal for that to see, prices higher than where they are now. So that's where we're sitting with the house prices. We actually got a full report coming out on this, the house prices later on today. So check it on the website for that. That'll go through all the different cities and go into a lot more detail about what we're expecting and what we're seeing within these. The only other thing I wanted to talk about on this was just some of these overall levels. Sorry, I'm on the completely wrong section. So some of the overall levels that we're seeing, and it is worth noting, when we talk about the changes, there's certainly significant improvement in almost all these ratios as we're looking across. So despite so usually what you'd say is house prices go up, that means therefore things get more unaffordable, and so therefore all these affordability ratios end up looking worse. Well, we've got the house prices going up, but at the same time, what we've got, we've seen significant increases in rent as well, and we've seen mind you, the rents are slowing down, but significant increases over the last sort of couple of years. And then we've seen the mortgage rate. So that's sort of this key factor as the mortgage rates have been coming down. That's what's really been improving that affordability ratio for most of these. So I guess what we're trying to get to there is it might seem like how much farther can a house push. They looks like they can push further. I guess in terms of our view, particularly if we're looking at further interest rate cuts. I might leave it at that. Just wanted to run a relatively quick one today, just to touch base on where we are on houses, and you'll see something coming out there. And then on that top 2%, and if you jump on the website as well, there's a full post on the that top 2%, and talking about how we're looking at it, and just that idea that what it is a real divergence in the market, and the right thing to be thinking about is not that, hey, this entire stock market is really expensive, I need to avoid it. But it's actually more about saying, okay, there's a top 2% is really expensive. The rest of the market is about normal. Do I want to buy the rest of the market if I'm worried about growth? And do I want to buy that top 2% and pay extra for those ones? Do I believe the growth is there, and how long is it going to last? And I think that's the right framework to look at it. And then within that, make the decision, as opposed to saying, no, the whole thing's no good. It's all too expensive. Anyway, thanks a lot, and thanks for listening in. We're on every Thursday, 12:30. Feel free to drop in any questions if you've got some. There's a question on. Oh, actually, sorry, there are a few questions that have popped in. Some thoughts on Woodside and some questions about some macro business ones. But I might follow up on Woodside. I'll pop something up on that as a different chat for you. And run through some of our thoughts there. Thanks, everyone, and we'll see everyone next week.